Are you tired of throwing your money into stocks that crash the second you buy them? Frustrated by hot tips that never pay off? What if I told you there's a proven, shockingly simple formula that hasn't just beaten the market but crushed it for years? Imagine turning $10,000 into nearly $1 million. This isn't hype. It's backed by real-world results. Today, we're diving into Joel Greenblatt's The Little Book That Beats the Market. I'm breaking down his magic formula, how it works, why it's so powerful, and how it could be the key to escaping the cycle of bad investments. Joel Greenblatt isn't just another finance guru. He's a heavyweight in the investing world, a Columbia professor and hedge fund manager who delivered jaw-dropping returns for decades. And his take on stock picking? He once said, "Picking stocks without a strategy is like running through a dynamite factory with a lit match. You might survive, but you're still an idiot." Harsh, but true. Most investors are gambling without a plan, blindly throwing money at stocks. But Greenblatt doesn't just call out the problem. He hands you a solution, a simple, almost magical formula that's consistently crushed the market. But before we dive into this magic formula, you need to understand why the stock market's chaos is exactly what Greenblatt's strategy takes advantage of. Imagine a giant like Apple. Its products are everywhere. Its brand is iconic. Yet over a single year, its stock price can swing wildly, from $160 to over $200 and back down again. That's a massive 25% fluctuation for one of the world's most stable companies. Did Apple's core business actually change that much in value? Of course not. Its iPhones, Macs, and services keep selling consistently. Or look at Coca-Cola, a company with a rock-solid business model selling drinks. Yet its stock price bounces up and down far more dramatically than soda sales ever do. This irrational volatility is exactly what Joel Greenblatt zeroes in on. He echoes Benjamin Graham's concept of Mr. Market, a manic-depressive figure who swings from wild optimism to crushing pessimism, all without any real change in business fundamentals. On good days, he's euphoric, inflating prices to absurd levels. On bad days, he's panicked, slashing prices on perfectly solid companies. For smart investors, these emotional swings aren't random noise, they're golden opportunities, and it's precisely this market madness that Greenblatt's magic formula leverages to identify undervalued, high-quality stocks. If market prices are often disconnected from reality, the big question becomes, how do we figure out what a company is actually worth? This is the billion-dollar puzzle that even the smartest investors wrestle with. Let's break it down. Imagine your friend owns a thriving coffee roastery. It's popular, has loyal customers, and made $75,000 in profit last year. Now they want to sell. What's a fair price? $300,000? $500,000? More? It's not a simple answer. First, you'd need to predict whether those profits will grow, shrink, or stay flat. Then, you'd have to gauge how reliable those predictions are, considering things like competition and market trends. And finally, you'd need to look far beyond just next year. If you own this business for the next decade or more, how much will it make you in total? This is the heart of business valuation, estimating future cash flows and bringing them back to today's value. Sounds straightforward, but in reality, it's a minefield of guesses and uncertainties, even for experts with advanced financial models. So, if professionals struggle to value a business accurately, what chance does the average investor have? According to Greenblatt, they're not doomed to guesswork. His formula is a practical shortcut, a way to cut through the noise and zero in on undervalued, high-quality businesses. Instead of trying to predict the future or master complex valuation models, Greenblatt suggests a simpler, more practical approach using two key metrics. The first is earnings yield, a powerful way to identify undervalued companies. It's like the PE ratio, but flipped and calculated using enterprise value to include debt. Think of it as the profit power relative to the price you pay. Here's a quick example. Imagine two companies, Alphatech and Beta Growth. Both are valued at $10 million, but Alphatech generates $2 million in operating profit, giving it a 20% earnings yield. Beta Growth, on the other hand, only generates $1 million, resulting in a 10% earnings yield. In this case, Alphatech is twice as profitable for the price, making it the cheaper, more attractive option. The magic formula zeroes in on companies with high earnings yields, those that generate solid profits for every dollar you invest. Buying cheap stocks alone isn't enough. Some companies are cheap for a reason. They might be poorly run in a dying industry or facing fierce competition. That's where the second key metric of Greenblatt's magic formula comes in: return on invested capital. Return on invested capital measures how efficiently a company uses its capital on both debt and equity to generate profit. It's essentially asking, how much profit does each dollar invested in the business produce? A high return on invested capital signals a strong business model with competitive advantages and smart capital allocation. For example, let's revisit our two companies. Alphatech earns $2 million in profit but had to invest $10 million in assets to get there. Its ROIC is 20%. Now, consider Quality First, which also earns $2 million but only needed $5 million in assets. Its return on invested capital is a stellar 40%. Both companies generate the same profit, but Quality First is far more efficient, squeezing more profit from each dollar invested. This efficiency often hints at a business with a strong moat or pricing power. The magic formula zeroes in on companies that have high earnings yield and high return on invested capital. The magic formula isn't some complex Wall Street algorithm. It's surprisingly simple, yet incredibly powerful. Here's how it works. First, Greenblatt starts by screening the entire universe of publicly traded stocks, filtering out tiny, illiquid companies. Next, he ranks each stock twice, once by earnings yield and once by return on invested capital. These two rankings are combined. Stocks with the best earnings yield and high return on invested capital makes it onto the magic formula list. Essentially, you're targeting high-quality businesses that are also selling at bargain prices. Now, this approach might sound almost too simple to be effective, but Greenblatt didn't just theorize this strategy. He rigorously tested it. From 1988 to 2004, the magic formula produced an average annual return of 30.8%. Compare that to the S&P 500's 12.3% return over the same period. Let that sink in. A $10,000 investment following the magic formula could have ballooned to nearly $970,000, while the same $10,000 in the S&P 500 would have only grown to about $70,000. Greenblatt even divided stocks into 10 groups based on their magic formula rank. The top group massively outperformed the market, while the worst-ranked group actually lost money. This consistency suggests that the strategy isn't just luck, it's exploiting real market inefficiencies that persist over time. If you're intrigued by the magic formula and wondering how to actually use it, Greenblatt has made it surprisingly simple to implement. He even set up a free website to streamline the entire process, magicformulainvesting.com. Here's a quick rundown. Visit the website. Go to magicformulainvesting.com, a tool provided by Greenblatt himself to help you apply the formula without complex calculations. Set a minimum market cap. Choose a company size threshold, typically $50 million or $100 million and above. This filters out tiny, volatile stocks and keeps you focused on more established businesses with reliable financial data. Generate the list. With a click, the site ranks stocks based on earnings yield and return on invested capital, providing you with a list of top-ranked magic formula picks. This saves hours of manual research and analysis. Build a small portfolio. Instead of trying to pick one or two winners, Greenblatt recommends spreading your bets. Start by buying 5 to 7 of the top-ranked stocks, investing 20 to 30% of your allocated capital. Repeat every few months. Don't dump all your money in at once. Every 2 to 3 months, go back to the site, get the updated list, and buy another batch of 5 to 7 stocks. This way, you gradually build a portfolio of 20 to 30 diversified magic formula stocks while averaging your entry points over time. Hold and rebalance annually. Hold each stock for around a year. For tax purposes, you might sell winners slightly after the 1-year mark to benefit from lower capital gains tax rates and sell losers just before 1 year to potentially offset gains. Reinvest the proceeds in new magic formula picks. Stay consistent and patient. This is not a get-rich-quick scheme. It's a long-term strategy that requires discipline, patience, and consistency. Greenblatt's historical data shows it can outperform the market over time, but there will be stretches of underperformance. Stay the course and trust the process. Important. This strategy, like any investment method, involves risk. Past performance is not a guarantee of future returns. Do your own research and consider seeking advice from a financial advisor before investing. Not ready to fully dive into the magic formula? No problem. Use it as a powerful screening tool to spot potentially undervalued, high-quality stocks, a shortcut to finding hidden gems without endless research. Joel Greenblatt's core message in The Little Book That Beats the Market is simple. Successful investing isn't about being a genius or having insider knowledge. It's about sticking to a logical, repeatable framework that cuts through market noise and keeps you focused on buying great businesses at bargain prices. The formula isn't a magic bullet, but it's a proven strategy that helps you avoid common investing traps, like chasing hot stocks or panic selling during dips. Want more strategies like this? Hit that subscribe button and stay tuned for more wealth-building insights.